Welcome everyone to the new episode of Market Decoded with Phileas Prop Firm. As always, our guest Djé from Derivative Trading. How are you doing, Djé, for this week?
I'm fine, and you? Thank you for having me today again.
I'm doing amazing, Djé. And for this week's episode, we are covering the very last major trading week of the year. So stay until the end of the episode because Djé has cooked us some amazing advice for every prop from traders to avoid losing 20% of their profits in 2026. It's a professional move and I've not seen it covered anywhere else. So let's get started for this week analysis and market outlook with the review of the global stock market fluctuations. So what happened this week?
Indeed, we can make a recap. We saw fluctuation this week with increasing bond yields amid the concern before the Federal Reserve meeting. There has been a shift in expectations regarding the Fed rate cuts, moving from 3 potential cuts by 2026 down to 2 and now 1. This has contributed to increased volatility in stock markets on Monday. Now the Fed has cut as expected on Wednesday and is starting to reduce the pressure on bank excess reserve by buying T-bills. That's a good news for now, and the Santa rally has officially started. The ongoing Fed interest easing cycle is a significant factor behind the rally and mainly on small and mid cap. We talked about that last week regarding the Russell, and as mentioned, the Russell is taking advantage of the move from the Fed because lower rate is reducing pressure on small and mid companies. That's why it is the main field to invest for the coming weeks. This move from the Fed facilitating also increase across major indices, including Europe and various Asian stocks. However, the tech sector is lagging, particularly due to Oracle earnings and guidance on CapEx, and Broadcom on its disappointing sales outlook yesterday also. However, investor sentiment remains strong as traders look to diversify portfolio and capitalize on market opportunities. So the Santa rally has officially started.
Amazing. So we've been talking about the Santa Rally for now 2 weeks and it's finally here. So I hope you guys will enjoy it as we give you the best update possible on the market. If you want to start trading futures without risking your own capital and get funded with the best trading conditions, join Phileas Prop Firm by clicking the first link in the description below and use the code PPYT at checkout to get the best discount available. Let's get back to the market analysis. Also, as the Russell, the Dow Jones making some all-time high.
Absolutely.
So what's the reason for the Dow Jones compared to the S&P?
This is the same reason, absolutely, like on the Russell. You have both small and mid cap also in the Dow Jones, but you also have a different sector that you have on the NASDAQ, and some sector are taking advantage of this environment of lower rates, which is facilitating their bond auctions for the coming months.
Okay, so different than the previous cycles where it was focused on tech, and now it's benefiting mostly the mid cap and more like maybe industrial and financial sectors.
Yes, absolutely. We have right now a stress on AI, as we discussed before, and a concentration of the investment in this sector. And right now, as the Fed is cutting rates and is starting a new cycle of accommodative policy, investors are starting to rotate their portfolio into small caps and mid caps in order to take the best opportunities. Because on big companies, the question is, are you going to make more on this kind of investment? But on small and mid, you know that you can make more.
Yeah, the risk to profit is more interesting for the mid and small caps. It has not yet benefited.
We have seen that on the Fed during the Fed meeting on Wednesday, with the Russell performing well better than the NASDAQ. If you check on one chart during the events, you will see that.
Okay, so maybe the best advice to give to traders, even if it's not financial advice, would be to, as always, follow the market flows and instead of focusing only on one NASDAQ, as always. So very interesting.
Absolutely.
So now let's move to the actual Fed decision impact and also the currency markets.
Yes, following the Fed decision about rates and also about T-bills, the US dollar is going to be under pressure and mainly against euro and Australian dollar. So if you are in Europe, it's time to hedge your dollar incomes. You are a trader and prop firm at Phileas. you receive US dollar, you have to hedge for next year because we can expect 1,000 pips on euro dollar for next year. So more than $1.25 for 1 euro in the middle of next year. This is my target. I think that euro dollar is going to rise big next year. Also in the Forex, the Japanese yen weakness against the yuan is raising concern about imported inflation in Japan, especially given the Bank of Japan cautious monetary stance amid raising bond yields. This situation affects investor confidence regarding Japan economic stability. That's why I think the next BOJ meeting next week will be very, very important. So we can have a big move on Japanese yen in the same time with euro against dollar next year. The euro dollar and the Japanese yen against US dollar are the main assets in the FX market. So you have to watch closely.
Whoa, amazing the tip you just gave. I think it's very overlooked, and most traders think about risk management as managing the position size, stop loss, everything, but they might not think about like, okay, I'm going to lose some part of the profits because I'm not managing the exposition on the currency I'm trading with, especially for traders outside the US who are not using the dollar. I've not seen it covered anywhere else. And so what can profit traders actually do about this risk and how to hedge?
Usually, they can discuss with their own banks, and bank can provide solutions like insurance or options or forwards. But your client can do this themselves, buying, for example, options in order to cover. You can buy a put on US dollar in order to cover the sell-off in the US dollar, etc., etc. We teach that at derivatives, and if some of your clients have questions, they can reach me.
And as always, the links are in the description below for Djé services. I think it's a very important point that you just made because traders might not look at this because I think it's not talked about anywhere else. So it was a very good point that you just made.
Yes, it is important to understand. Maybe you are a good trader, you are going to make money on prop firm or on other stuff, but your profit, you are going to consume it in your country. So if you are in Europe or in Asia or in the Middle East, you are going to consume your profit in your local currency. That's why you have to hedge it, because today the dollar looks strong, but in 6 months, maybe the dollar will be well below the current exchange price. And this means that you are going to make less revenue.
Profit will be diminished just by the exchange rate if the situation stays like this. So very good point. Thank you, Jay. Anything else on the Fed decision?
Now, regarding the Fed decision, everything's clear. We are starting a new cycle of accommodative policy. It isn't a quantitative easing. People have to understand that. By buying T-bills, the Fed is just making a kind of reverse twist. This means that it's going to lower the pressure on the bank, and bank can finance their activity, but this isn't meaning that banks are going to invest in stocks market, etc., etc. This is reducing pressure for banks, but for now it isn't a quantitative easing in which central bank is going to buy long-term assets, long-term bonds in order to inject liquidity into the financial markets. This isn't a quantitative easing. I know on Twitter, X, people are going to say that this is a quantitative easing, but it isn't.
Compared to what we talked about last week when we made the two scenarios, it was clearly the dovish reaction that we expected from the Fed.
Actually, on Monday, the market have, as mentioned before, have shifted because in Europe, you have Schnabel and Casimir from the ECB who told us that maybe the next move from the ECB for next year could be an hike of interest rates and not a cut. In the meantime, in Australia, the Reserve Bank of Australia told us also on Monday that maybe the next move in Australia could be an interest rate hike instead of what the market was expecting. And why? Because they are expecting a bounce on inflation for both Australia and Europe. That's why on Monday, the market, mainly the US bond market and bond trader, have started to think that maybe the Fed is going to deliver a rate cut, but with an hawkish guidance. That's why we had a small sell-off on Monday. Then the Fed started its meeting, and finally it was more neutral, close to be dovish than what the market has expected. And that's why we had a rally, and mainly on Russell.
Okay, perfect. Let's now move to the current most hyped and assets of the moment, gold and silver. So what's happening on the precious metals market?
Again, interesting this week. We discussed last week and previously. Exchange traded funds ETF added big on ounce of gold to their holding yesterday following the Fed decision. This bringing the net purchase for the years to 15 million ounce, making the largest one-day increase since October 21. Gold prices have risen 63% this year, supported by lower interest rates and increased demand from central bank and ETF, as mentioned for yesterday. Additionally, what is interesting, ETF are accumulating close to 4 million ounces of silver and close to 400 troy ounces of palladium. That's why all metals are clearly bullish. ETF are buying big.
Okay, so looking at the big flows, we can see that there is no sign of stopping the trend. So I think it's really good news for all the traders positioned on the metals.
Absolutely. For now, as we expect the Fed to be accommodative, yes, it's clearly bullish for precious metals. But in the coming months, we will be vigilant about inflation discussion in Europe, in Australia, in UK, and in Japan. This is the main element we have to watch closely, but bullish for now.
Okay, now I think we covered most of the big news event, the Fed mainly, and the markets. So what's the outlook for the coming week and the end of the year?
Actually, we can expect the Santal rally to continue in the coming weeks, but next week is the big last week for the year. We have several data to be published, mainly jobs, inflations, and some central banks in UK and in Japan. So technically, we should have continuation of this rally, but we must be vigilant and watch closely the data which are coming to be published next week.
Perfect. So be vigilant, but still very good for the Centaur rally after this Fed decision. I guess we can now move to traders' favorite segment, the trader pro tip. So what do you have for us, Jay?
The key takeaway related to the last 2 weeks of December is that historically, these weeks are often positive for US stocks, as we mentioned with the expression Santa Rally. However, it's important to remember that institutional investors are on holidays during this time, which means serious trading won't resume until January. This can result in decreased liquidity, leading to more erratic price movement. Therefore, if you want or if you plan to trade during this period, you must prefer swing trading instead of scalping and adapt your exposure accordingly. And I guess your prop firm provides swing trading accounts. So the tip of the day is in the market, it's not you who impose your setup, it's the market that dictates it to you, and market condition can move quickly. I know that retail investors usually they have a setup, but they must understand that you are not going to impose to the market what is your view. The market is moving, the conditions are changing, the environment is moving also quickly, the flow are moving, and you cannot say that okay, I have my setup, the market is going what I am expecting. One day you can use, for example, and you see that if you use, for example, options or spread future strategies. One day, for example, you can take a position to play volatility or directional move, and another day you have to start mean reversion strategies.
Yeah, that's a great tip. That's a great tip again. And I think with the end of the year, with the liquidity drying out, it's very important to not mess up all the profits of the year and be a bit more cautious. And indeed, as you said, we have the swing accounts at Phileas. So if you want to try them out, use the first link in the description below. Use the code PPYT at checkout to get the best deal available. And for sure, not forcing the trades, not having only one setup and just forcing it just because this is what we are used to and not seeing that the reality of the market changed. It's a very powerful skill to have, to see the different market dynamics changing over time and adapting to each market conditions. So I think it's perfectly adapted to this end of year.
Absolutely, because the main flow which is pushing the market is a long-term move or term move. If you want to take advantage of the move, even on scalping or on day trading, you have to understand that, because even if you want to scalp the market just before the Fed meeting, for example, you know that the market is not going to move. So you don't have to take directional move. You have to short volatility, for example. Day like that, you cannot just take position, have a long position and expect a big move. That's why you have investors who are losing money, because sometimes they take position as they are expecting a big move and they don't take profit. And sometimes they take profit too quickly while there are big move in front of them, because they don't understand what is going on in the market. The best way to take advantage in the market is to have several strategies. If you are able to trade in spread future, trade in directional, scalping, etc., you have several ways to trade. If you are able to do that, and you adapt to the condition, it's okay for you.
Yeah, having more tools in your back pocket to be able to use the right one. It's like if you want to build a house, you're not going to just use a screwdriver. You need the entire equipment. So you need to have all the tools and to know when to use it. So it's like, okay, now the liquidity is drying out. Maybe it's more long-term positioning and not like short-term moves. So maybe you should adapt your trading style to the current market conditions, especially for this end of the year.
Yeah, absolutely. Erratic movement we will have in the coming weeks is very dangerous for scalping strategy, for example. So the best strategy you have to do is to reduce your size and go on the market on swing trading. It's well better for the coming weeks.
Thank you again for this amazing tip, Djé. And as always, if you want to join Djé courses and services, links are in the description below. Okay, so I think it's everything. We covered everything for this week. Again, amazing content from you, Djé, amazing tips and analysis. So what do you want to say for the last word?
Merry Christmas. Thank you very much.
Okay, everyone enjoyed the Santa rally. I hope you are enjoying it as much as we do. And we'll see you in the next one. We don't know yet when it will be. Maybe next week, maybe next year. So everyone have a good week and good end of the year. Trade safely.